Welcome to our eSignal Weekly Forex Forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. Before we get to the report, some words of wisdom from the great Warren Buffett himself. Time is the friend of the wonderful business, the enemy of the mediocre. Same thing is true in trading. There are no mediocre traders. And we're going to explain along the way why this is so and why this is so apropos to what we do. First market, we're covering the Aussie US dollar. We've been pretty adamant all along that the Aussie's going to move lower. Potentially, we think this market will probe below 80 even. Near-term target here is the 50% retracement of this primary bull move here. We think you'll see a complete 50% retracement of it. Here it is, right in there. So we think that's a first stop. 3 words why we think the Aussie will continue lower. Lower commodity prices. Definitely lower commodity prices will continue to pressure this market lower, and we'll cover those commodities when we get to the gold market also. So we think some more downside for the Aussie. You know, back to that weekly chart, I will say this, however, we don't necessarily see a black hole below the Aussie as we do in the European currency. We think there's just somewhat limited long-term downside to the Aussie, and probes below 80. They'll be worth taking a look at. For now, though, plenty of room on the downside in the Aussie. Next market we'll take a look at will be the dollar chief. The dollar Swiss, you see it found support right at a 625 retracement. Pretty characteristic behavior of a bull market. Longer term, 95 even was upside target for us. It overshot that, as markets often do based on momentum. So it wouldn't surprise us if overall you're ready to take a pause here in the Aussie. Here's the weekly chart. You can see you're starting to get into previous resistance. We think historically the market will overcome that resistance. However, nearer term, it wouldn't surprise us if this move starts to see some consolidation overall. We would definitely encourage investors and longer-term traders, however, to hang on to those long-term positions, because you don't know whether a correction will take the form of a sideways move or a more violent downside correction. So you just don't know. What we do believe long-term is this market will continue on the course that it's set in the second half of this year. And when you look out at a monthly chart, this is really going to give you a perspective as far as how much room is on the upside. And we'll give you, some of the reasons why we feel that's going to continue when we cover commodities also. We think commodities is the key to this. We think that the dollar strength forecast commodity weakness, and we think you're going to continue to see longer-term commodity weakness, which in turn will continue to fuel the bull in the US dollar. Speaking of the dollar, there it is, very similar to dollar Swiss. You see that heavy black line? That marks the breakout for us. We'll go to a weekly chart, and that's a major breakout for us. We still think there's the possibility that you could backtrack and perhaps consolidate some of that gain, and perhaps even go back and retest that area where it broke out from. Let's go back to a monthly chart. But by no means will that mean, we see potential dollar weakness. We're not saying that at all. Nothing goes straight up. In fact, it's quite normal for markets to have corrections. In fact, shorter term, longer term, intermediate term, we feed off of corrections. We love when markets correct because that's the time to step in and essentially buy a dip in an uptrend or sell a rally in a downtrend. That's really our MO. So, possibility that you pull back and test 84 even, that's something that we'll look for. Really near term, realistic near term upside target, still going to be 88 even, and a breakout from that level will really put the dollar in a position to move on par, to move on 100. So that's something that we look at down the road, a little closer to what's happening here and now. You see how quickly the dollar recovered that correction. And that's what we say. That's what we mean when we say we don't know whether a market will have that, that violent downside correction that we'd like to see that'll prove an opportunity to be a dip to buy, or whether it just goes sideways. And that's why we always say, hey, maintain those long-term positions. That's why we've been saying maintain those long-term positions. You have to approach this market from an investor standpoint now, especially if you have a big lead on some of those long positions. Next market, the euro. Here's a market where we just feel there's so much to the downside, and that really shows up on a monthly chart. And I'm kind of a broken record here. You guys know where I stand, and you guys know where we stand with the method. We think that 110's in the cards, and potentially steeper than that. we'll take you out to a futures chart to really give you the scope, that long-term scope, and you can see, aha, 110, not that big of a deal. And there's one where if it were to break 110, we think there's a lot more room below there. Whereas you going back to the Aussie, we thought, potentially a break of 80, you could see some kind of a climax below there, and then you'd start actually the accumulation process, and that market would potentially carve out a floor. That could take a long time. Not so in the euro. We think you break 110 here. Probably getting a little bit ahead of ourselves because you got to get through 120, then 110. But if you start to take out serious support levels in the euro below, or I should say potential support levels in the below, that it could get ugly. So we think there's a lot of room still below, even on these historic charts in the euro. So that's why, hey, maintain your short euro positions. Continue to sell rallies in that market. You can see how quickly this little short covering rally here fizzled out, and boom, it's headed right back down. So from a long-term investor standpoint, you definitely want to maintain shorts. The gold market, you had a little dead cat bounce at 1180. We'll pull out to a weekly chart because you're gonna see what the structure everyone's looking at. Everyone's talking about the structure right here, 1180 or so, and they're saying, hey, potentially a triple bottom. And that could be the case. People are talking about you have a potential triple bottom, potential support here. Well, when we consider gold, we always want to look at silver. We know silver has a long-term track record of being a bit of a leading indicator for the gold market. And if you look at silver, you see a lower low. You look at Friday's rally in the silver, it's an inside candle. It couldn't get above last Thursday's high, let alone close above it. So we still see that as a bearish development in the gold market. And here's probably what's even more bearish for commodities, vis-a-vis bearish for gold, would be crude oil. We've been talking about this. We talked about this last week, that the potential meltdown in that market, and you saw it. You saw a continuation of it. You had a close below support at 90 there, and that really just opened the door for the downside, and you had pretty steep losses in the crude oil market this week. Here's the daily chart to put it in perspective. There you go. So we think you'll see continued downside for the crude oil market. Here's a monthly chart of the crude just to give you scale and show you how much downside there was in the crude. So when you look at that chart, 70, it'd be pretty realistic. I mean, 60 you couldn't even rule out, right? So we think there's plenty of room down below in the crude oil market. Who's that going to be best for? That's going to be best for consumers around the globe, particularly so for U.S. consumers, because we're the ones that drive. The U.S. consumers are the ones that fill the tank up the most. It's going to be great for China too. It's going to be great for the global economy, but it's going to be best for those consumers who have the petroleum, who have the gas in their own country, because they're not going to have to pay the transportation costs on it, right? So who would those people be? It's going to be great for the U.S. primarily because we have a pretty steady supply of it. The U.S. is very close to being a net exporter of crude oil if they aren't already. So we have the crude oil here. We don't have to pay a lot to transport it. It's already here, and it puts money in our pocket every time we fill up, because we're spending less to fill up, and that tank of gas is going further now as well. So a big boon for U.S. consumers, crude oil prices. And when you look at this monthly chart, hey, that trend kind of just began, didn't it, right? So if you look at a daily chart now, it'll look like, oh, wow, crude oil is awful cheap. Maybe we consider buying it because it's so cheap. Is it cheap? It got down to $84. But when you look at $84 is cheap to where it's been in the last year, but historically, and that's what you want to focus on, the big picture. Is it cheap historically? No, not by any means. Last market we're going to take a look at would be the dollar yen, and we put a support line here. Let me pan out. Let me drop down to a daily chart, and yeah, you can see the support line we drew. It got to 108 was our upside target. We said, hey, if it gets to 108 with the momentum, it'll probably get to 110. It kissed 110, tagged 110. Now it's back down in the 107 handle. So, and you're not seeing it recover either. It's not recovering. Dollar yen here is not recovering like dollar Swiss did in the dollar index. So we think that you'll see a more violent, more volatile correction here. but we think that a natural downside target here would be 105.5 or so. So we would look to potentially see the market consolidate down to 105.5 and start to carve out a bottom there. So that's how we see things in the dollar yen. And back to what Warren Buffett said, you have to take the long-term view. You have to know what you're doing long-term, because then time is your friend. Because if you don't want time as your enemy, right? That's why time definitely is the enemy of the mediocre and the friend of those that know what they're doing. So you have to take a long-term view. You have to get time on your side. I'm going to give you another little bit of advice here from one of my mentors, Bill Williams. If something's not working for you in the market, you have to change it, right? Words of wisdom from Bill Williams. Trying to change your trading without first changing your mindset is like trying to convince yourself that a merry-go-round has a destination, right? Great quote from Bill Williams. My name is Jay Norris. I teach at Trading University. Thank you so much, and we'll see you next time.